This podcast is part of the Frederick Podcast Network. Learn more at listenfrederick.com.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor, Hummingbird Wealth Management, LLC, and Cambridge are not affiliated. Now sit back and relax and enjoy another episode of Be the Hummingbird. Here's your host, Laura Johnson.
Hello, and welcome to Be the Hummingbird. This is our podcast where we try to educate, motivate, and inspire you. And what are we inspiring you, motivating you, and educating you to do? Well, hopefully through some of the conversations that we're having, you'll get the education you need to recognize that, hey, I'm not so bad. Life is good. Or educate you on a level that motivates you to do that thing you've always needed to do or wanted to do. I mean, the whole purpose here is to kind of share life's journey and some of the tidbits that I've learned along the way and share that knowledge with you and hopefully you gain something out of it. So what is today's topic? It's that wonderful thing called taxes and really what the role is of taxes in financial planning. So let me tell you, I work with over 100 clients and I've been doing what I do for over 30 years. And the key thing, well, there's a lot of key things when it comes to financial planning and making sure your financial plan is successful. But one of the key things besides healthcare in retirement that a lot of clients don't take into consideration, or even financial planners don't take into consideration, is the impact of taxes. And currently we're in an environment where we don't know what the future of our tax world is going to be. We have an idea of what taxes are going to be with the current administration after the end of the year, but our current tax laws in 2025 are actually going to expire at the end of 2025. And if nothing is changed, the average American, middle American, is going to see an increase in their federal tax rates. And so it's something you not only need to address while you're financial planning, but it's something that needs to be addressed on a regular basis. We make it a regular habit to, when we sit down to do an annual review for our clients, is to ask them for a copy of tax returns. And this is where I'm going to say to you, I am not a CPA. I hire somebody to do my taxes. It's too complicated, and there's way too many laws out there that are constantly changing for me to be able to do my own taxes. But why do I ask my clients for a copy of their tax returns? Well, a lot of times your tax preparer is doing what they're doing for you. I hate to say this, but in a rush environment, right? They have a deadline that they have to get those taxes taken care of for you, usually by April 15th, unless you're a business owner and they're due by March 15th, or you're a nonprofit and they're due by May 15th, or you filed an extension and they're due by October 15th. But there's always some kind of deadline that's going on. But it's in those beginning months of the year that's real stressful on your tax preparer or your CPA. And so a lot of times what they're doing is very numbers driven. They're in front of a computer. They're clickety-clacking on their keyboards and doing what they need to do to get your return done in an efficient amount of time. Now, if they've been working with you for years and years and years and have gotten to know you and have had, opportunity to know your business or your lifestyle, they may be more capable of giving you advice on what you can do to lower your tax burden. But a lot of times CPAs aren't in the business about helping you lower your tax burden. They're just helping you to file your tax returns. And that's okay. We definitely need people like that. But it's always good if you don't have your CPA or your tax preparer doing that for you to have someone else take a look at it. And that's what we do. So when you're looking at taxes, what are the taxes? Well, there's one obvious one, and that's income tax. And that's basically the tax that you're paying on the income that you earned, whether you're employed by somebody else or you're employed by yourself. There's always some kind of income tax. Now, one of the things a lot of new small business owners don't take into account is this thing called Social Security tax. When you are self-employed, let's back it up a little bit. When you are employed, there's this line item that comes out of your paycheck that says Social Security and Medicare. On the opposite end of what you have taken out of your paycheck, your employer is also paying that same amount in Social Security and Medicare. So when you're self-employed, who's paying both ends of that? You are. And a lot of times, people who are getting into business for themselves fail to take that into account. They're like, how come I had to pay this 15.5%? I was like, well, that's your Social Security tax and Medicare tax. And so you want to make sure that you're accounting for that. So there's income tax. I've mentioned the Social Security. There's capital gains tax, property tax. You got to keep that into mind as well. This is not just about your tax returns. Estate and inheritance tax, and sales and consumption taxes. And all of these things play into your overall financial plan. That's why a lot of people say, well, I'm thinking about moving to Florida. It's like, well, what's your main reason for moving to Florida? It has nothing to do with the sunshine that they have down there. It has a lot to do with how they tax retirees in the state of Florida. And there's several states in the 50 states of the United States of America that are like that. But Florida, in my experience, tends to be the most popular and most well-known. And so obviously that has a lot to do with income tax, that people will be saving on their state income tax if they move to a state like that. Then there are some people who say, well, I'm going to move to Delaware. And I'm like, well, why are you going to move to Delaware? Well, not only do they not have a state income tax, they also don't have a sales tax. They don't charge you anything when you go to buy anything. So in the state of Maryland, we have a 6% sales tax. I'm saving 6% just by crossing over that Delaware line and living in the state of Delaware. So what is capital gains tax? Capital gains tax is when you buy something and you sell that something for more than what you bought it for. And depending on the time frame that you've had that is whether or not you're going to pay a short-term capital gains tax or a long-term capital gains tax. Now, your amount of tax that you're going to pay is highly dependent on, like I said, whether or not it was owned less than 12 months, that's short-term, more than 12 months, what the gain was, and what your overall income is. And that's going to determine what that tax is going to be. But obviously, this can have an impact. So if you look at your investment account as an example, and you have over $100,000 in what we call unrealized gains. And what that means is on paper, you can see it's worth more, but you haven't cashed it in. That's what unrealized means. But when you realize it, meaning you sell, ABC stock and you made $100,000 more than you spent on it, that $100,000 is going to come to you in a form called a 1099. It's going to have a capital gains line on it, and you're going to include that on your income for your tax returns for that tax year. That has its own tax rate, which is different from your income tax rate, which is different from your sales tax rate. These are all different tax rates that you're going to have. Now, property tax, that's another reason people will say, hey, I'm moving to Delaware. I'm not promoting Delaware, by the way, but they have a lot of benefits. One of them being state income tax, one of them being your sales tax, and one of them being property taxes. I know living in the state of Maryland and where we live in the state of Maryland, our taxes are probably 600% more for a similar house and a similar property as it would be in Delaware. It's just a choice of where I want to live versus, I want to live in, where I live instead of the state of Delaware. And so it can have an absolute impact on your financial planning as well. And when I say an absolute impact, you got to think about this in dollars and cents. If you say to me, I spend $50,000 a year, let's say $60,000. So $60,000 a year. So $5,000 a month. But you're thinking about things like utilities, groceries, entertainment, eating out with your friends, maybe going on a vacation, car insurance, putting gas in your car, clothes on your back, and your prescription drugs. That's how you're spending your $6,000 a month. You've paid off your house, you're retired, you're happy to go. Then I'm going to start asking questions like, okay, well, what about your property tax that you have to pay every year? Oh, yeah, I forgot about that. That only comes once a year. Okay. Well, what about the investments that you have that you're going to liquidate in order to fund your income to pay for everything you're paying for? What about the capital gains tax on that? And then, oh, by the way, what about that retirement plan that we're now going to start withdrawing from and the income tax you're going to have to pay on that? So in order to give you the $50,000 you need, we also need to account for the tax impact on whatever it is that we're providing to you. So what are some ways, let's say you're not retired, you're still accumulating and growing things along the way. What are some ways that you can minimize your taxes? So this is what I'm going to tell you first and foremost. If you're making a lot of money, it's really hard to avoid taxes. I hear a lot of people say, well, the rich get richer because they don't have to pay taxes. Trust me, they pay taxes. A lot of times when you see people who are wealthy that you feel as though they're not paying taxes, some of them may be business owners. And business owners do have, I don't want to say an unfair advantage. They have a very fair advantage. As business owners, we get to write off business expenses. That is money being spent. That's money being added back out into the world. But because it's an expense related to our business, we're able to write that off of our income. Whereas those individuals with W-2 employees go out and spend money, they can't write that off. But it's not a legitimate business expense, so it's fair. One's being used for business purposes and one's being used for personal purposes. And so what are some ways that you could take advantage and possibly lower your income taxes? One of them is contributing to a retirement plan. Some of you are going to have the benefit of having an employer that has a 401k or a 403b or a TSP that you can contribute to. And depending on your income limits, you can contribute up to a certain level. And if you're over the age of 50, you can actually contribute up to $31,000 in a 401k, 403b, or a TSP this year. And so what that does, it takes your income, and let's call it $100,000, and it reduces it by whatever you're contributing. So even if you contribute $5,000, what it does is it makes your income go down from 100 to 95 from a tax situation. Now, this is where I'm going to be like, but there is this thing called a Roth IRA, a Roth 401k, a Roth 403b, and even the TSB has a Roth portion. So what is the difference between a Roth on your taxes versus a traditional 401k on your taxes? Well, a traditional retirement plan on your taxes reduces your current income and your current tax liability. A Roth does not, very simply. So if you have $100,000 in income and you put $10,000 into your retirement plan, in a traditional situation, it's going to take your taxable income from $100,000 to $90,000. But in a Roth situation, it's only going to take it from 100 to 100. But why do people do Roths? And this is, again, a tax situation. The reason they'll do a Roth is they're gambling, betting, predicting, whatever word you want to use, that by the time they retire, that asset, despite no tax benefit currently, is going to give them great tax benefits later on down the road. And that's a whole nother podcast, but just real quickly, a Roth anything, Roth IRA, 401k, TSP, 403b, grows tax deferred until you decide to pull it out, as long as it's been at least 5 years and you're over the age of 59 and a half. When you go to pull it out, you're going to pay no taxes on the withdrawals. You're also not going to have any required minimum distributions. So if you don't want the income, you don't have to take it. A lot of pros to going on the Roth side of things. If you don't know if this is something that's good for you, again, give us a call. We're more than happy to sit down, analyze your income, analyze your investments, and let you know what we're thinking. We are talking a lot about Roths in the last couple of years and probably for the next couple of years. One of the other things that you want to look at is we do have a high standard deduction on our tax returns currently. So a lot of people just go, throw their arms up in the air and they say, I'm not even going to bother with itemized deductions. You always want to take a look at itemized deductions because you may be able to, between charitable deductions and property taxes, income taxes, all those types of things, medical expenses could take you over that standard limit. So that's another way to reduce your taxes. You want to make sure that if you have investments that you're considering tax efficient investments. And these are the types of things that you possibly are not going to pay state taxes on, or depending on the type of investment, you might not pay federal income taxes on. And so that's something you want to consult your financial advisor on as well. You do always want to plan for major life events and what the tax implications are going to be. So one of the things is selling your home. If you sell your home and you have more than $250,000 in gain that you're going to realize, or $500,000 if you're a couple, then you have to prepare for the fact that you might have to pay a tax on that excess gain. And always, 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 when you have questions, work with a professional. On taxes, I would recommend that you work with a CPA. On the overall financial planning and the impact of that, I would recommend working with a certified financial planner. So I hope that this conversation didn't depress the heck out of you. I know taxes, especially this time of year, can be very hard. They're hard all the time, but especially around this time of year. But I hope that you were educated enough and motivated enough to take a look at what it is that you have and be inspired to maybe change a couple of things in your life to make yourself and your financial plan overall more tax healthy. So this podcast has been brought to you by Listen Frederick. And as always, it's not goodbye, it's see you later.
Live radio, local podcasts, the Frederick Podcast Network at listenfrederick.com.